Okay, in this video, we're going to talk about break-even point and contribution margin, and just kind of give you a little introduction to cost volume profit analysis. So cost volume profit analysis is how we estimate the changes in cost and see how that is going to affect our company's profit. So depending on our sales volume generally, what's going to change in our cost based on our sales volume. So cost volume profit analysis here, the systematic examination of relationships between selling prices, volumes of sales, cost, expenses, and profits. So effectively, we're going to say, okay, at a given sales volume, what is our cost going to be? And we've learned already how fixed and variable costs vary based on volume of output. But now we're going to kind of add another piece to that and effectively say, all right, how does the sales side, so my sales price and revenues coming in, and how does that change? So it'll tell us how many number of units we need to break even. It'll tell us the impact of a reduction in fixed cost on the break even, and the impact of an increase in price on the profit. So it kind of gives you information, it allows you to budget and give you kind of future information, or at least estimates on what your profits are going to be based on a given volume and a given sales price. So we'll look at the contribution margin income statement in this. We're going to look at how to find break-even point in units and in sales dollars. And we're also going to look at the contribution margin ratio, variable cost ratio, and the break-even point in sales dollars, which I think I already said. So break-even point. Break-even point is information that's useful and valuable. And what it means basically is, where do we make $0? At what level of sales are we making $0? Well, that's never the goal of a business. Generally speaking, a business's goal is never to make $0. What break-even point shows us is basically a risk analysis of, okay, what do we need to do in order to not lose money? Obviously, the goal is always going to be to go beyond that to actually make money. But it's kind of that, it's a nice kind of initial hurdle on, where is it that I at least don't lose money. So the revenue break-even point is a level of business operations at which revenues and expired costs are equal. So my revenues are equaling my expenses, basically. So my operating income equals 0 at this point, at the break-even point. So my operating income, which we would get from an income statement, is my total revenue minus total expenses. So at break-even point, my total revenue equals my total expenses is one way to say it. Also at my break-even point, my total revenue minus my total expenses equals 0. So all those things are just saying the same information more than one way, basically. So another really important word and part of this that you really need to know is contribution margin. So a contribution margin is the sales less the variable costs and variable selling administrative expenses. So the shortest way really to say what a contribution margin is, a contribution margin is sales minus all of the variable costs, effectively. Now, just like everything else, this can be done on a scale of being in total, or it can be done on a scale of per unit. So if I was going to do contribution margin per unit, that would equal the sales price per unit minus the variable costs per unit. Which basically says, if you think about the word contribution margin, so margin generally we're talking about the difference between two things, and here you got the difference between our sales price or our sales and our variable costs. There's a difference, that's the margin part of this. In contribution, what they're talking about here is how much of every sale contributes towards covering my fixed cost. How much is each time I sell my product going to add to the pool of money, the revenues really, but the margin pool of money that will cover my fixed cost. Because that cost, remember, is something that's more like a period cost or time frame, not a direct production cost, generally speaking. So we want to know how much and how many sales, or what quantity of sales would break even, but we use a contribution margin generally to do that. And I'll stop this one there for now.